Good morning. My name is Eric Horseman. I'm a partner with Cherry Becker, a top 25 accounting and advisory firm. My co-host for today's webinar is Danny Kajawa with PNC Bank. On behalf of the firm and PNC Bank, welcome to this industrial webinar. Today's webinar is being recorded, and we will provide a link subsequent to the webinar in case you wish to access. In addition, while the speakers will not be answering questions during today's webinar, please feel free to drop us an email, or you can put a question into the chat and we will make sure your questions get answered by the experts. A little about your host for today's webinar. PNC Bank is a top 10 financial institution with an array of products to help industrial companies meet their needs. My clients have enjoyed working with them as they are forward-thinking and helping companies achieve their goals. Cherry Becker partners with our clients in much the same way, looking to help guide our clients forward down the path to success. Today's webinar will feature some of that forward thinking from both PNC and Cherry Becker. You will hear today from Treasury experts at PNC, as well as a state and local tax expert at Cherry Becker. But first up is Bryce Gartner, leader of our data analytics practice, ESIMO. Bryce is over 20 years in the industry helping clients use their data to enable them to make informed decisions. Bryce's focus today will be on leveraging analytics and supply chain management. With that, Bryce, take it away.
Thank you very much. Looking forward to it today. Good morning, everyone. I'm going to share my screen. So as we think about supply chain in the world that we're in today, we can't really talk about analytics and how that impacts supply chain without adding disruption. The last 7 months have really shown us that as we look at the data, that there's been significant elements of that. As we look and move forward, what I really want to do today is help break this down. A lot of times we get mired in our overview of thinking about analytics and supply chain and all the disruption, but I want to break it down. Part of my responsibilities, in addition to my corporate responsibilities, are I'm an adjunct professor at the graduate school, the business school at Duke at Fuqua. And a lot of times I work with the students, just like we work with our clients, to really simplify things down and to really get our head around some of the complex processes that we face, and really focusing on how we make analytics into what we can do. But first, we have to really understand each of these elements and how we need to think about them differently in today's world and in today's environment. As we break this down, analytics very rarely gets talked about without talking about the Gartner group and how as a group of analysts, they've broken analytics down into this ascendancy model. Really, we think a lot of times in terms of how analytics happen at a descriptive basis. Really, that's what we traditionally think about, our reporting, generic reporting, and then maybe some deeper dive into diagnostic. Not only what happened, but why did it happen? And we get into that deeper level of looking at things. There is a lot of talk today about predictive analytics and even more so prescriptive analytics. So what's gonna happen? How can we make it happen? And as you can see, when Gartner thinks about this, they put that on a value and difficulty spectrum. Now, one of the challenges I've seen, and so I took the Gartner side of the equation and put the Bryce Gartner version on the screen now, which is one of the things that the ascendancy model, I think, doesn't take into account. Is a lot of times people look at an ascendancy model and they think about it in terms of, I'm trying to get to the top level. Well, we're not just trying to get to the top level. As we work our way through and as we get deeper into analytics and we have a good understanding of analytics, what we have to understand is that our data is going to continue to feed each of those. We can't just get to a predictive or a prescriptive model and think that's the end all be all, because there are going to be elements that change. There are going to be things that change. There's going to be elements of disruption that we really need to dive back into the descriptive and diagnostic to make our predictive and prescriptive models better. So when we understand analytics, that's a key component to understanding how we can now look at supply chain. We need to think about looking at it through all of these different lenses and look for opportunities to increase that level of value. The second part of the equation is managing, right? Managing our supply chain and using data, using analytics really means that we have to get past some of these really scary statistics, right? When we see a statistic like only 16% of organizations say that more than 75% of their employees can use data, have access to the data, what we know is that we have a big opportunity inside all our organizations to do better than we're doing today with data. When you combine that with the fact that Harvard Business Review and MIT points to a ton of studies that talk about the increase in performance, profitability, efficiencies, all the other gains we get, especially surrounding supply chain, when we are empowering data throughout our organization, when you combine those things, it becomes very important. We also have to think about we're using all the data we possess, and the fact that we've got to think about not just using the data at the lowest levels, but how do we dive into leveraging analytical tools that are available to us. And so when we start to put these two things together, the analytics and managing, we have to make sure not only that we're thinking about analytics in the right way, but that we're also thinking about how we get them implemented to where it's not just a data science group or a group of analysts that have access to that data, but how does everybody in the organization take advantage of it? When we traditionally think of supply chain, what we have traditionally thought is we think about raw materials. We think about taking those raw materials and producing them into something that ultimately is a codified product that's either part of another product, feeding the supply chain of another product, or it's a product that we're going direct to consumers with. When we think about that, we also have to think about in supply chain logistics. We have to think about where we're storing it, how we're getting it distributed, what kind of things fall into supply chain, into those elements, and how we do analysis around each of these. Traditionally, we also then think about how we get that to the customer. Well, what we're seeing today and what we're seeing as a result of the new world we live in, as a result of other elements coming into play, we're really thinking differently, and we're working our way backwards, right? The most important element of what we do in supply chain is making sure that the end customer, whether that is a consumer that we're delivering our product to, or it's another business that we're delivering a material to or a component to, that it's got to get to them. That lets us work our way back through the supply chain, working our way back to the logistics, working our way back to asset performance management, and performing on how our manufacturing processes performing at the individual level on the manufacturing floor. How are we sourcing our raw materials? Are we getting them all from a single source? Where are they located? What quantities? What can we expect as deliverables? We've got to work our way back from our ultimate goal of getting it in the hands of the consumer and thinking about how we apply analytics to each and every one of these steps, but continue to stay focused on our goal. What we've seen in the last 7-8 months is something that we haven't seen before, but McKinsey recently released a study on risk resilience and rebalancing in the value chain. And what you see here are all of the different possibilities of disruption. And a pandemic is one of those. And the cost of a pandemic is another. But there are also a lot of other things that we have to take into account today. And as you can see here, they used a scale of the magnitude of estimated cost and the ability to anticipate. And so as we think about some of these items that some of you have maybe already faced, where we think about there are governmental issues that come into play, whether that's regulatory or trade relations, whether we have environmental events that are happening as a result of climate or weather or other components that can cause disruption. Social, clearly this summer in the US, we've seen unrest and turmoil cause impacts to different elements of supply chain in either getting it all the way to the consumer or other components. Just standard economics as a component. And then we have the criminal elements. A lot of times in our analysis, we don't take into account some of the aspects of criminal elements, and criminal elements being these cyber attacks, being people counterfeiting, being theft, and how all of that impacts our supply chain. So as we put all of this back together and we think about how analytics and getting data in the hands of the people who need it, and then thinking about how we take those elements and understand supply chain, looking at our ultimate goal, we have to put all of these things together when we start to think about analytics. So what are some of the keys to how we can use analytics in our supply chain, and how can we think about it differently? Because we have people who are thinking about supply chain very differently than they were before. But one, we have to think about how do we communicate this? A lot of times we're really good at numbers. We might be the CFO, or we might be a division controller, and we're thinking about how we understand numbers. Well, we have to remember that a lot of the people that we're working with, a lot of the people who need to leverage data, need to understand data differently. And we need to think about how we engage audiences. We need to think about how we provide insight in simple ways to demystify this complex analysis. I use this image that we have on the screen right now to show you a little bit about how we think differently and how companies are thinking differently about analytics. And there aren't any analytics on the screen, but this is a picture of Times Square. And every advertisement that you see here, there's been a lot of thought about the audiences that they're trying to reach, and how amidst the clutter of what's going on in Times Square, how we grab the attention to engage the audience that we need. How do we grab their attention and make sure we're communicating either what we do or what information is important? And so very much like advertising, today we have to think, because there's so much data flowing at us from so many different systems, be it financial, be it marketing, be it operational. How do we think about demystifying this and providing the right information to the right people at the right time? And so if we start to work this backwards, I'm going to take you through kind of a use case from one end of the supply chain to the other to think about how we start to communicate data and data questions we need to think about. So I'm going to walk you through a series of data stories that help us get a complete understanding of supply chain. So as we look at our supply chain, we're thinking about, remember, the end consumer first. We're thinking about what our goal is, because that has an impact on what we need to do up the supply chain. And thinking about, in this case, product reviews. In our mythical example here, we're looking at product reviews. How do we look at, in this demo company, how do we look at what products are selling, what information is there, and then how do we understand how that applies to what we're thinking about? Well, higher rated products tend to drive to be more successful. Lower rated products, unless a commodity that's required, tend to drive less. So how do we start to incorporate existing consumer behavior, existing consumer patterns into our thought process for our supply chain planning? We then start to add layers to this and work our way back. So as we start to leverage that, how can we start to take those variables, some of the variables we talked about before, whether it's environmental, whether it's some of the other elements that we have to think about in disruption, but how can we feed in some of that data, and how do we start to get to our best use cases using analytics, using predictive analysis and alerting to understand where we are in inventory relative to looking at days sales, days of inventory, all of those components. How do we leverage that to better understand and better plan for where we're going? Because once we get better at forecasting and leveraging the capabilities of predictive and prescriptive analytics, then it gives us the capability to work our way back even further, to understand and dig deeper into how our channel is performing on the backside of supply chain, understanding which products are driving more effectiveness and where we're seeing the greatest success, working our way back into then planning, inventory planning, production planning, understanding where we need to alert people, where we are carrying more inventory or where we have a deficit of inventory. Oops. And then how we're getting inventory, how we're getting supplies to us, what the impact of our logistics side is, how that plays into the model, all the way getting down to how are we performing on the production floor? Where are we seeing losses? Where are we seeing failures? What areas are causing us the greatest failure rates in components of manufacturing? All of these examples are using sample data, but we're taking from real world examples of where clients in supply chain have really leveraged data in different ways at all of these different points, all the way down to evaluating, thinking about an audience that's incredibly familiar with their manufacturing floor and understanding where failures exist, how they exist, and what is the level of failure that this has as an impact. Now, all of this isn't, you look at something like this and we immediately think, well, IoT has got to be everywhere in here. It doesn't. It all comes down to how we manage this process, how we manage the production flow, how we manage our capacity, and how we push things through, but have a better understanding where opportunities fall. As we think about this communication component and how we communicate better with data and how we take advantage of it, we really need to think about some additional elements. Besides communication, everything surrounds in analytics and supply chain surrounds our critical questions. Our critical questions are really about how do we impact our preferred future? So we have to think about strategic objectives. We have to think about our goals. And then we have to do two things. We either have to be looking with our analytics to prove out a theory that we have that can either improve our supply chain or have a significant impact on our supply chain, or we need to be looking to disprove what I call organizational mythology. And a lot of times, organizational mythology gets started with, well, because that's the way that it's always worked. I know nobody on the call today has ever heard that, but we've heard it plenty of times. We've never looked at that because this is what we always believe. And so as we think about the ways that gets put into play and in practice, I'm going to bring a very specific example to bear. We recently did work with a large global auto parts manufacturer. They were looking at and had gone over time looking at gross margin suppression. They felt like their gross margin was not where it should be. They evaluated what they were doing in demand planning, in the warehouse management, in the sales distribution channel. And quite honestly, the visual that I have on the left side looks very much like what they discovered. They had 7 product lines. In each product line, they had somewhere in the neighborhood of about 20,000 individual products, SKUs. And what they looked at and what they expected to find was driven by organizational mythology, that they had a certain product lines that were dragging everything down. Well, in reality, what they found was it wasn't a certain product line. It was products across all product lines were suppressing that level. Well, when you're looking at traditional reporting and not doing analytics around it, you're looking at lots of rows and columns. Well, when you have lots of rows and columns on 20,000 products in a product line, you summarize and you roll up and you roll up and you roll up and you lose the level of granularity. Well, what happened is taking some of the new tools that exist for doing analytics, they were able not applying any fancy or high on the ascendancy level predictive or prescriptive modeling, but doing a more simplistic diagnostic analysis, they discovered that they had key products in every product line that were really suppressing their gross margin. The impact for them was a $48 million impact on the first year. And then by applying these principles on an ongoing basis, what they really were looking at was discounts, inventory turn, and production cycles. Just three very simple things that we think about every day. And so understanding the critical questions and putting deeper thought into some of the diagnosis, they were able to have a tremendous impact on the organization. Actually the third key component that we have to think about are the data elements. We think about what it takes to do analysis, and a lot of times we get overwhelmed. We get overwhelmed when we're thinking about supply chain because we don't know where to start. Do we start at the consumer end? Do we start at the vendor end? Do we get in the middle of some of the things that we have more control around? And where do we get the data? A lot of times we're just thinking about the data that we have. We're thinking about ERP data. We're thinking about operational data and Internet of Things data. Or we're thinking about marketing systems, whether that's sales systems or marketing communication systems or the other systems that we're familiar with data. All of those are very important in the overall scope of making good analytics decisions around supply chain. They give us really solid insight into what's happening. Using predictive, we can use it we can get ourselves further down the road, but we also should be thinking about external data. What data can we go get that's going to have a significant impact on our ability to predict the future or prescribe solutions? Well, a lot of times those fall into some of those things that we saw in disruption, whether it's regulations or government actions relative to tariffs or trade restrictions or other components. Weather a lot of time has an impact. Our vendor supplier factors, being able to require those people to provide us data, being able to say not everything, but key components that we need to identify that are going to be critical in us managing our supply chain and managing it more efficiently and more effectively, especially in an uncertain climate. And so our ability to do more is really about that. How do we take full advantage of the data we have and the external data that is out there and start to incorporate it into our thinking? Because we are truly limiting our capability of what we can do with analytics if we're only thinking about the data we have and not thinking about where we acquire other data. So I want to talk about a group that really thought that way about data. This is an online auction company that focuses specifically on heavy equipment. Their supply chain, if you will, is really about how do we identify equipment that we can sell, that we can get into our supply chain, that we can then make available to sellers, that we can have an impact on what happens in that supply chain. Well, they had some very specific goals. They wanted to accelerate their growth. They were already growing, but they wanted to look at it, and they looked at the information they had, internal data, viewers, bidders, buyers, who are the people that are taking a look at the products. But they also knew that there were some very important elements that drove what kind of products were getting purchased. Financing trends. Who was financing new heavy construction and agricultural equipment? What is the weather? If there were macro weather trends happening, like droughts in certain areas, or lots of precipitation that was driving flooding or saturation, they knew that had an impact on how products were moving throughout different regions of the country. They also identified that publicly available data such as home starts were leading indicators for what they were going to see in how types of things moved through their supply chain. So what impact does this kind of thinking have? For this group, they've been on Inc.'s fastest growing companies for 7 straight years. And in the 5 years since they took this approach and we've been working with them, they've seen 20x growth. Because simply they weren't satisfied with just looking at internal data. They really sat down, thought about what external data could have a significant impact on their supply chain, driving it from beginning to end. Finally, I want to talk about AI, artificial intelligence, and machine learning. This is all about finding opportunities. When we think about this, as we all know, as we're going through hurricane season on the East Coast, we get more AI and machine learning thrown at us during a named storm period than we even recognize. Everybody's seen the spaghetti models. Everybody understands how those spaghetti models tend to play out, how they tend to trend, how ultimately they give us a view of where the storm is going to fall. That is using tremendous amounts of data, both internal data and external data, and a lot of different forces that play upon the history of hurricanes, what happens in different situations with different fronts moving. Well, that's what we're trying to do if you think about it relative to supply chain. We're trying to understand better how the impact of the hurricane in our world, what we need to produce, what we need to get to market, how we get it there, how we get more control over the pathway of what's happening in our organization. And so it's about designing models that incorporate more data, like I just talked about with external data. It's about those understanding how, when we see those spaghetti models start, when a hurricane is off in the distance, south of the Caribbean, we see how broad and how many different possible lines there are and how those narrow their focus as they get closer. Well, we have the ability to do that inside our supply chain and then ultimately prescribe solutions. When we take this and we apply this, we talk about how a client of ours really leveraged this in pharmaceutical all the way to the selling point. Their goals were to improve the product pickup by physicians, meaning keeping the consistency of what they were buying at the levels that they were buying of specific products, but spreading greater across their product lines. They wanted to find and build models that could be predictive and prescriptive, that when a salesperson, when they were face-to-face or on the telephone, that was giving them the same kind of capabilities that they saw that people see when they're on Amazon when they get a recommended product. And so what they were able to do was start to dive into historical data, start to dive into trends of information that was not only what they had, but also had outside influences, things like new patents, new patents expiring, new products entering the market from competitors, alternative methods of solving the same issue. And they started to incorporate that information. And what they were able to do was essentially see a double-digit same-store growth across the physicians and groups that they were reaching out to. It also helped them see an increase in inventory turn on a lot of the products that they put in the second tier. They weren't their lead products, but they were ancillary products that could be used in conjunction with, that had much lower inventory turn, that had a much lower growth trajectory. But what they saw by incorporating this information was growth in that area, and applying some of the models that help them on the fly better understand their customers and not just what they were buying, but how they were buying and what were some of the impacts on that buying. So the key things I want you to walk away from with this today are just really the 4 things to keep in mind, right? The critical questions that you need to ask that are driving the mission, not are the things that are just driving our singular objective, but what are the things that are going to have a greater impact on the larger objectives of what we're trying to accomplish in supply chain, getting it in the hands of our ultimate customer. And how do we work our way back? And what are those critical questions that we need to ask at every stage of the supply chain? What are the data elements that impact us internally that we have, but what are some of those key data elements externally? And then as we evolve and as we advance, how do we add AI and ML to our delivery model? How do we start to incorporate and step our way into leveraging some of those capabilities? And then the most important one, and that's why I saved it for last and I started with it at the beginning, all of this information in a vacuum does us no good. We have to make sure that we're sharing this information, that we're getting it in the hands of the people who are making supply chain decisions, the people who are determining what production of a certain product will be for a certain day. We've watched that be successful at companies of all shapes and sizes. The other component of this isn't something that's just for the largest manufacturers. We have seen this successful all up and down in various sizes of organization, from the smallest manufacturing companies to the largest global providers. Everybody can take advantage of pieces of this equation and will be more successful for it. I really want to say thank you. Appreciate the time today. Hopefully I was able to give you a few nuggets of things to take back to your organizations. I'm going to turn it back over to Danny to take us into some of the next content that we have today.
Thank you so much, Bryce. This is Danny Kajawa with PNC. Very interesting presentation. It gives data geeks like myself something to get really excited about. So we're going to switch over the presentations. So you'll see not only a couple people will be joining via video, but also we will switch out the PowerPoints. So we're moving to our next presenters, Aaron Deal and Dan DeHanna. Aaron and Dan work with PNC here in the Carolinas. Aaron primarily focused on the Charlotte metro area as a treasury management officer, and Dan is a regional sales executive overseeing the entire Southeast for PNC's treasury management line of business. So their presentation today is focused on optimizing your company's cash flow. And as a primer for their presentation, I read a recent quote out of the Wall Street Journal from Paul Moody at the Hackett Group, saying that through a recent survey that they did in the UK, that companies who cut their cash flow conversion cycle by 7 days added between 1 and 2.1% to their earnings margin, which is real money. I will hand it now over to Aaron, who will take it from here.
Great. Good afternoon, everybody. I'm hoping just, Danny, can you just confirm that you can hear me?
I can hear you.
And you can see my screen okay?
I can.
Wonderful. Okay. Well, thank you all for having us. We're excited to be here and to talk through a cash flow health check, right? So that's what we're going through today. Just the idea is to better understand how you can take a look at your AR and AP process and make sure that they're healthy and that they're doing well, and what tools your banking partner can provide to you to really assist with that project. So let's dive in. Let's see if I can. Okay. We don't necessarily know the magnitude of the recession at this point, but I think it's fair and that we can all agree that the economic fallout from this disruption is going to be unprecedented. Companies have an increased focus on normalizing and right-sizing their SG&A expenses today and their delivery model of that, so that it's relevant given a potential decline in revenue and that it calibrates with new business expectations as we move forward. At PNC, we really encourage our clients to resize their enterprise cost structures from a perspective of value optimization rather than pure cost reduction. And that ties directly into what Danny was just talking about, lengthening that cash flow cycle or to maximize financial impact. We understand that this can be an effective way to strengthen income statements, build stronger financials as we're heading into this next normal. And we do this for clients by helping them focus on value-added tasks and eliminating manual processes. And what we've noticed with companies that we work with and our clients is that they're commonly overlooking their order to cash and procure to pay cycles as sources for cost reduction. Typically what we're hearing from a lot of business owners is that, well, this is the way we've always done it, or it may be manual, but it works for us. And that's fine. And we see year after year, those similar comments and those processes remain stagnant. And I would say that the pandemic has really challenged a lot of companies to peel back the layers and look at how they're managing receivables and payables, because what's always worked is no longer cutting it. For example, right, and you all may have experienced some of this, but with fewer staff in the office, receiving payments has become a challenge. Do you have people in there to go and make deposits, whether it's a scanner or taking them to the branch for deposit? And then what does that slowdown do? There's a trickle down effect. If you're slowing down cash flow from a receivable standpoint, are you able to take advantage of discounts anymore? Or even in a worst case scenario, are you even able to make payments or have on time, right? Have your payments been delayed that they're no longer on time? And that's a scenario that we're seeing more and more with our customers. So the idea of really diving in and looking at these process and even gaining 1 or 2 days of reduction of float can really be a huge impact for making on-time payments or taking advantage of those discounts. And I would say too, the slowdown also has become heightened when cash is paramount. I'd say too, a lot of our clients, we've seen a shift in their liquidity strategies from highest return to things more like security, ready access to cash, transaction flexibility, and cash management. That highest rate return is no longer the top priority, partly because rates are at a historic low and likely will be for the next several years. But also just there's a lot of uncertainty in the market and we just don't necessarily know kind of what's going to happen day to day. I do think there's a quote on this page that is really kind of pinpoints this and highlights it. And it's that bottom one that just says, and you guys probably can relate to this, but that companies have been pursuing aggressive cost saving strategies for several years. But all of that low hanging fruit has been harvested. So what that means, right, you've probably taken out all the things that you know you can already automate and do. And so that's where we think that these processes can really aid in that. Okay, so from here, we've talked about the need to optimize, to add efficiencies, to reduce costs. And you may be wondering, well, how do I achieve that goal? What we would recommend is doing something like a business process review, right? That's what we call it at PNC. Other institutions may call it something different. And it's something that although your banking partner would be a great asset to help you walk through this, you can do these internally as well. So the business process review aims at taking a deep dive into companies' AR and AP process. We've learned that doing that can present a lot of opportunity to create efficiencies, and understanding that not all efficiencies are going to be a one size fits all. And that's where your banking partner can really be an asset to right sizing scenarios and finding tools that are going to be most relevant to how you're doing business. Because even if you're in the same industry as somebody, it doesn't necessarily mean that you're operating the same way. So one solution is not a one size fits all. So we use
one
this.
thing I'll say.
Yeah.
Eric, if I can jump in real quick. The one thing I'll say about this is that we've been offering this for years, and as we went through the crisis and people leaving the office and going from home, people are coming to us asking us to help them with this. We've had
Absolutely.
a lot of people who, as Aaron said, were doing things because it worked. This is just the way we always did it. It just now they're looking at it saying, we need to find a better way to do this. We need to be more resilient. We need to be able to handle this type of thing before we would have some type of crisis like this, whether it was a hurricane, it was a weather event, you'd be out for a couple of days, maybe a week. Now we're talking 6 months. One of the best ones I heard was we had a client that everybody was working from home except for the CIO. So the chief information officer was going in, just making sure systems were working, making sure everything was going forward. And part of his duty was to go to the AR clerk's desk, find any checks, prepare a deposit, and go and deposit them. Now, obviously, that is not the process you want in place. And this process, with just kind of looking at everything you do, where are the resiliencies, where are the manual processes that can be corrected, is really, really important as we prepare for the new normal. So I think it's a really, really great process for you to sit down and go through with. Again, whether internally with your financial partner, with a consultant, and that's it's just something that we're really encouraging people to do.
No, absolutely, absolutely. Thanks, Dan. That's super helpful. And I don't know, it looked like my screen was maybe jumping, so I apologize. I'm not sure what's going on. So if I lose the slides, we'll just maybe kind of continue on. And so yeah, Dan, you really highlighted kind of everything that I was hoping to accomplish and stuff like that. I'm thinking too, I mean, sometimes we talk about this with people and they look at it as a really daunting task, especially when we're talking about both AR and AP and looking at it all at once. It doesn't have to be all at once, right? It can be a segmented approach. And really that is what we'd recommend. Let's look at the process or the side of the business that takes the most time, that has the most manual components to it. And then that's where we would really dive in. So how do we do that? How do we dive in? You may be asking, you may be wondering that. First, we're going to start with collecting information, right? We want to collect as much upfront information as we can. So that could be an analysis statement, a bank statement, account structures, right? If you have account structures or any existing processing maps, all of that kind of stuff, we love to get up front. We love to take a look at it. And then we schedule something where we can really walk through one cycle or the other. So whether it's order to cash or procure to pay. The example that we were showing today is really around order to cash. So we've collected our upfront data. Then we want to have this detailed discussion. And you'll see kind of the sample questions that are on this page that we're going to walk through with the client. A lot of it focuses on not just about the actual receivable item. So it's not just how are you getting paid, but it really takes a step prior to that. And let's understand your customer mix. What is the breakdown? Is it all B2B? Are there some B2C? A combination? What does that look like? And then what does your billing look like? How often are you billing? Are you emailing those bills? Are they being physically mailed? Are you doing any e-invoicing? Maybe you don't do bills at all. Maybe you've got statements. So how do all those processes fit together to then ultimately receive that payment so that you're getting paid timely and that you're getting paid in the manner that you prefer? And a lot of that comes down to what your invoice or your bill looks like. So not only do we want to talk about it, but we want to take a look at your invoice. Are you including on there that you're open to receiving electronic payments if that's a preference? Are you putting your account number on that bill? It's not something we would recommend, but there are tools to mask your account number to make sure that it's not out there making you more vulnerable. Do you have a due date on your bill? You'd be surprised. Sometimes invoices show up and there's no due date. It'll just say 30 days based on the receipt of this. And well, you don't know when your customer is actually receiving it. So that makes the on-time payment a little ambiguous. And if you're offering any kind of discount for paying early or paying on time, then that might be kind of null and void if people don't actually know the date that they owe you money. And then from there, once you get those payments, how do you apply that cash? What data do you need in your accounting software or in your ERP system to actually apply it? Is your bank providing the information that you need? Maybe they're not, because maybe they don't have it, right? So sometimes there's a gap in what the information your bank has that they can share with you. And sometimes by using simple tools to provide your bank that information, they can match those payments and send them automatically to you for a faster cash application.
And one thing to think about is we're looking at this, your customers are going through the same challenges as you are, right? So there was a lot of times where customers would not send electronic payments or wanted to send checks, wanted to make a payment a different way. They didn't want to do it before. Now they have to do it, right? So by looking at that, looking at who's paying by check, looking at how you're receiving payments, you're able to sometimes get your payments faster now, believe it or not, even through this crisis, in that people want to make those payments that way. We have seen a big increase in people now accepting credit cards who would never accept a purchasing card before, right, for their payments, just because it's the easiest way for their clients to pay them and the fastest way they can get paid. So there's a lot of things as we're looking through this whole process to think about, and that we can hopefully identify and help you go forward.
Yeah, that's so true, Dan. And the one rule of thumb we always say with receivables is be flexible in how your customers want to pay, because you're more likely to get paid on time if you're flexible. So whether that is accepting credit cards, electronic payments, checks, kind of every aspect of that receivables continuum, for sure. Sure. So this is when we meet with companies, we try to make sure that we're looking at their process from kind of beginning to end, and not, like I mentioned, not just the cash, or the actual receipt of the payment. So all the way from order to fulfillment to any exceptions managed or past due collections. Right? We want to look through all of that. There are a lot of times people think banks can really only come in at that middle section where the payments are being received, but there's just a lot we can do on the front end and the back end as well. So I typically like to walk through this with clients of mine, just so they have an idea of a typical order to cash cycle, gives them a little bit of a picture. And then we just did the same thing here on the procure to pay. Same ideas, right? There's more to the procure to pay cycle or payable cycle than just distribution of funds. It really starts with procurement, and then also receipt of invoicing. And what about POs? Are you using POs? You doing a three-way match? How does that all come together for your approval process? Is it a very manual process? Are you mailing things from office to office to have actual approvals, or is it all done via email? Do you have some sort of online platform that allows different departments to make those approvals, so you have an audit trail and you can see all of that and what's been done? Or is it just a stamp, right? It's a really manual process. Somebody's just stamping it and kind of sending it to the next office, and then it gets to AP and it's being paid. And on the very back end of that is reconciliation, right? How easy is your reconciliation process? Where, if you're using a large payment mix of different types of payments, check, card, ACH, wire, that can make reconciliation a little bit complicated. So what tools do you have at your disposal that can streamline that process, automate it, make it easier, make sure that whoever in AP is doing that spends 10 minutes a week instead of 2 hours a week doing that actual reconciliation? So we've talked a lot about the business process review on the very beginning of the presentation, and after we do that questionnaire, we have then tons of data about your business. So we're able to generate a sample process map. So it's high level, but what we essentially do in this scenario is we take your process and we map it out. Anything that's a red box is going to show a manual process. So that's really where we're targeting our efforts, is to minimize those manual processes. So this is from an existing client of ours, and they really ran into manual issues with printing and mailing bills, right? They have just a lot of bills and invoices that they do in-house and they mail, and it's taking one of their AP clerks like, it was like almost 2 days every week to do that process, as well as from a reconciliation standpoint, you'll see the red boxes after the bank portal side, pulling reports and then finding the invoice numbers and manually keying those into an ERP system or accounting software. Some people refer to it as either, or even if they're receiving electronic payments and then they're getting those that remittance emailed to them, how do they match those payments and then put them into the ERP? That was also something that was a large issue for them. They were taking a lot of time tracking down partial payments from electronic because they weren't getting the remittance information that they needed, or they were getting it 2 days ahead of time and then the payment didn't come in for several more days. And so it was really a manual process that just took a lot of time, as well as some exceptions in the lockbox, right? Those had to be printed daily and then manually posted to the ERP system, which are all things that we can help automate and make more efficient. So also note, we don't do this in a vacuum, right? We're going to present this process map to you. We want to sit down, we want to go through the process again, make sure that we haven't missed anything, make sure that we understand everything, that there's no piece that we've left out, or that there may be something that is really relevant that we didn't dive into deep enough. So we would use that opportunity to do that when we review this high level process map. And then this is where we get to the ultimate goal, right? This is another process map, but you'll see far fewer red boxes. So the idea is that we've automated a lot of those manual process for the client, made it more automated, and that reduced the expense of having somebody do a lot of those processes. And then we're able to repurpose some of those individuals to then look at the exceptions, right? That's really where the manual effort should be focused, is managing exceptions and working with past due collections, because those are the things that the bank can't necessarily expedite for you or automate. So here, a client that was billing had tons of bills. They ended up migrating that to a print mail solution, so PNC is able to then mail and print on their behalf. And this is agnostic to PNC, right? There are other companies that do this, but the idea is that you're getting the paper out of your office and you're moving it to somewhere that they can assist with that for you, or you're sending bills online, and customers then have the ability to log in, make payments, view their invoices or statements, that kind of thing. And additionally, from the lockbox standpoint, we're able to, we call our lockbox integrated receivables, but we're able to add in electronic receivables. So that eliminates the issue of having emails coming in for remittance and electronic receivables coming into the bank account, and we in the industry we call them a decoupled payment. We can marry those, so we can put them together, so you're getting one consolidated receivables file, and that can include checks, wire, ACH, credit cards. We're actually able to process all of that. And so the idea is getting behind a solution that isn't specific to one payment type, but is able to accommodate all payment types. And again, this is a sample from a customer that we did, and it is specific to the receivables process, but we kind of do it on either side. I think so. The other thing from here, this is how we recommend that you do a health check of your processes. The best way to do it is to dive in and see what's going on. Work with one of your partners and make sure that you've kind of left every stone unturned, and that you're able to really figure out ways where you can reduce those costs, where you can eliminate those automated or those manual processes in favor of an automation solution. That eliminates time. And the end goal then is for this particular one is to decrease DSO, right? So you want to get the funds into your account as fast as you can, so that you're able to make payments and disperse and take advantage of discounts, kind of all of those good things.
And you can see on this, I mean, it's a very resilient process, right? Is that, you know, before this client was mailing and printing all of their bills, all of their invoices, due to everything that's been going on, they're now presenting payments, you know, online, emailing invoices out, doing that type of thing, sending the information to their customers the way their customers want to see it, which allows them to be more resilient in that they're not waiting for invoices and having to go pick them up in the offices. So there's a lot of benefit here that came through. And to Aaron's point, you know, PNC has products to address all these issues, but it's not necessarily, you know, us saying, oh, buy our product, do this. It's just, this is where we see you could gain efficiencies. Can we solve them? Of course, but there's other alternatives out there that, you know, ideally what we're trying to do is just find the best way for us to be able to help you as well as you help yourself be able to make this process a lot more efficient and a lot more resilient. And that's the point of the whole review. And we really recommend to everybody really doing some type of review, whether it's internal, whether it's with a partner, whether it's with a consultant. There's a lot of folks out there that can help with it, but it's something that, you know, as we're looking at how we're going to be doing business in the future, it's so important to look at this process to make sure that on this one, to get your money as fast as you can, right? And that's a very important thing. And we just want to make sure that we're helping our clients do that.
Absolutely. And that's kind of what, you know, all we have from a cash flow health check standpoint. But we're happy to we're not doing questions today, but to take questions offline. If you have questions, if there's anything we can help with, if you're interested in reviewing this kind of process with us, let us know. And I will turn it over to Eric.
Thank you, Aaron and Dan. That was a lot of great information to take away for improving your treasury activities. In today's environment, I think we can appreciate shortening the cash collection cycle. Let's keep things moving. Next up is Chris Grimes, manager on Cherry Bekaert's sales and use tax team. Chris has been working in this area for a number of years, both with our national firms. He has consulted with our clients on a number of issues, especially those that were recently impacted by the Wayfair decision, which has left many industrial companies scrambling to meet their sales and use tax obligations. Chris's focus today will be on sales tax cash savings opportunities for industrial companies. And with that, I'll turn it over to you, Chris.
Thank you very much, Eric. So, I assume everybody can see my screen. So, our goal is today, as Eric mentioned, we're going to try to find out if there's any type of opportunities out there that can generate any type of immediate cash savings for manufacturers. And in addition to that, we're also going to be looking at opportunities kind of long-term where we can help reduce or eliminate exposure for businesses. So in order to address those topics, we have four areas to discuss. There's the manufacturing process, general manufacturing exemptions that come along with the process. We have a section related to COVID-related exemptions, sales tax training, and exemption certificate management, and also managing audit exposure. Through going through these four topics, you should find that there are going to be several means of generating immediate cash savings and also through reducing long-term risks through audits. So the first part, as mentioned, manufacturing exemptions in the production process. So overall, when you're considering manufacturing, there are four key areas that generate cash savings for manufacturing businesses. We have machinery and equipment, we have production supplies, we have packaging supplies, utilities. Most of these are generally self-explanatory what they are, except with the exception of production supplies. This is kind of a term that's been that's coined by Cherry Bekaert essentially. And that involves really all kinds of different supplies like chemicals, catalysts, raw materials, safety apparel, basically all kinds of things that are utilized within the manufacturing process of a business. However, they don't necessarily meet a definition of machinery and equipment, but there are states that do provide exemptions on this. So in order to take advantage of all four of these areas, assuming that the state offers them, the first key issue that needs to be identified is what is the production process for your business? Now, just because a company is a manufacturer and the state does offer a manufacturing exemption, it does not necessarily mean that all manufacturing equipment, all machinery and equipment, all production supplies and things of that nature are all going to be exempt from sales tax. It's really key to basically find out where the process begins, the manufacturing process begins, and where the manufacturing process ends based on the state's particular exemptions and definitions of manufacturing. So there's a lot of variability. One of the states that I typically use for an example, I'm based out of Georgia, so Georgia makes sense for me to kind of start here. But so Georgia offers an extremely broad production process, essentially, or definition of what constitutes manufacturing. So with Georgia, we have our map here basically that shows that we have incoming raw materials that come to a manufacturing site. There's a transition to raw material storage, first production machine, and so on throughout the remainder of the process to get to packaging, finished goods storage. Now, with Georgia, like I was saying, really early on in this chain here, right after materials are received, so that first green bullet that says incoming raw materials, as soon as materials are transitioned out of that first area, really begins the production process in Georgia. And it'll continue to flow on all the way through the conveyance of items from the packaging line. So we go through 4 or 5 bullets down to into packaging line. Packaging occurs, things start to get conveyed out to finished goods storage. So Georgia, huge room for what constitutes manufacturing. However, there's a lot of variability in states. Some are much more narrow than Georgia, such as like a state like Ohio would basically narrow everything down to first production machine to packaging line. They don't consider any of the conveyance to those machines, so getting a forklift, taking it from raw material storages to first production line, or from taking a forklift from into packaging line to finished goods storage. So much more narrow, and very important that this production process is identified, because in order to take advantage of these manufacturing exemptions we're going to discuss, they need to fall in those parameters. So the first item to discuss, everybody, near and dear to everybody, is machinery and equipment. So just because we've gone through that first criteria and identified there is a beginning process, there is an end process, that's not necessarily the end all be all answer, that everything that's machinery and equipment that's purchased within that process is exempt. So we have to do some additional consideration. And one of those first consideration points is this a direct use state that our manufacturing facility is located in? Or is this an integrated plant theory location state that our facility is located in? So what does that mean, right? So direct use is going to be a much more narrow exemption. So really with direct use, the simple thing to consider is you're going to want to have a piece of machinery that's actually making a physical or chemical change to the product, to the raw materials, or raw materials of work in progress. Now, if you have a machine that is making that physical change, very likely an exemption will apply. So you can complete your manufacturing exemption certificate, provide it to your vendor, and purchase that good for use, exempt, as long as that machine is exclusively used in that manufacturing process. But we also have another theory. It's called the integrated plant theory, and this is a much more broad exemption. So direct use, extremely narrow, must directly touch, chemical change, physical change, something of that nature. But with the integrated plant theory, since it's so much broader in scope, you can really get like one step removed from directly making an impact on the actual good being produced. And what I mean in that manner is, so if we take a consideration something like forklifts. So if I have a forklift that's used to take a work in process item from machine A to machine B, forklifts, of course, aren't directly impacting or changing the product being produced. But in an integrated plant theory state, the forklifts are necessary and essential to the production process. So certain forklifts may actually qualify as being exempt, and there are some exceptions to the rule. We'll talk about that in a minute, but basically forklifts are a good example because there's really no impact on it, or no impact on the actual good being produced. In addition to the forklifts, there's a couple other things that you can consider as well. Some states, I think Georgia and maybe California, for instance, it will allow an exemption for maintenance equipment. So I have a manufacturing machine, and then I have this other maintenance machine that's basically used to perform services and work on the manufacturing equipment. So assuming certain criteria are met, that maintenance machine could actually qualify for a manufacturing exemption as well. And the same kind of thing would also would apply to like cooling equipment. Cooling equipment's not necessarily going to be causing a direct impact, but it is making the process continue to run. It's necessary and essential. So if you're cooling down an item that is directly used in manufacturing, then without that cooling equipment, the other machine can overheat, basically cease the whole production process. So those are a couple examples of what the differences are between direct use and integrated plant theory. Should be significant more opportunities to purchase goods exempt from sales tax in an integrated plant theory state. Now, so we identified there's the manufacturing process, everything from A to Z within that process, and then we have to also consider direct use integrated plant theory. And then there's one more final consideration as well, and that is how the goods or how the equipment's being used. Is this a stationary machine that's exclusively used like 100% of the time within those parameters, the manufacturing process parameters? Some states are going to say exclusive use is requirement, so 100% of the time. Some are going to say primary use is required, which is going to be more than 51% of the time. And some states will also say substantial use is required. So substantial use is basically getting to that point where it's going to be 33% of the usage occurs within the production process. And really, if you think of like the machinery equipment, may not be a whole lot of movement going around, but the big key area that people run into this issue with really has to do with the forklifts. So if you're in an integrated plant theory state and you have forklifts maybe used pre-production, in production, and post-production, it's a good practice to basically either assign those forklift uses to a particular area, so all pre-production, all post-production, all in production, so you can take advantage of the exemptions accordingly, or you're going to have to find some other means of monitoring how regularly these forklifts are actually going to be used in non-manufacturing activities versus manufacturing activities. So another topic on machinery and equipment. So when we're talking about repair parts, just like the machinery and equipment is going to be typically exempt from sales tax, the corresponding repair replacement parts are likely going to be exempt as well. There are, of course, exceptions to the rule. So you have certain states that are going to say that like the machinery needs to be capitalized, like California. It's not necessarily good enough that you're replacing like a belt or air filters or something along those lines that are directly, they are definitely a component part of the machine, but it can't be any type of expense to purchase. It has to be something that's going to be capitalized. Luckily, this isn't a whole lot of states, but it is something that needs to be considered when determining whether or not you take advantage of this type of exemption. So is there a useful life criteria? You have states like Arkansas as well that say that it can't be just any type of repair. You have to have a substantial repair or substantial replacement. So you think of like, like an engine being replaced or like a motor being replaced. It needs to be something material on the actual piece of equipment and machinery. So on top of the repair and replacement parts, and then of course always think outside the box on this, whether or not there's any type of like non-traditional types of equipment that may apply for an exemption, such as HVAC related things, lighting, pollution control, anything along those lines. So there are states that do provide particular exemptions for these topics. It's just you'll need to really consider whether or not these items are necessary and essential in a integrated plant theory state, or if there's any particular exemptions basically on these topics. So the next area has to do with production supplies. And again, it's a general term that we use at Cherry Becker here. And it includes new, it includes numerous different purchase categories, such as raw materials, sanitizers. Sorry, seem to have some problems here. Hopefully it sticks this time. So it includes numerous different categories, such as like raw materials, sanitizers, oils for machinery and equipment, pollution control chemicals, safety supplies, a whole different plethora of different items. Now, honestly, you're not going to have a one size fits all when it comes to exemptions here. So what I mean is, when we're considering all these different topics, there is a significant amount of variability that you're going to see between states, whether or not they treat certain goods as taxable, certain goods exempt. So generally speaking, there's really 4 approaches that states are going to take. Now, you're going to have instances in which some of these production supplies, they directly touch the product, remains on the product. And those are typically things such as like raw materials and whatnot. Or there could be some other kind of chemical or oil or something put on something to strengthen it, to make it more durable. So generally speaking, if something actually goes into the product and you can physically see that it remains in there, raw materials, then usually that's going to be exempt. Now, you have the other instances in which this is kind of what I was talking about with the cutting oils and whatnot. Now, this isn't necessarily something that you can like eyeball and see in the product, but it does make this type of change. It makes it more durable, makes it more resistant to heat, something along those lines. So if there is a chemical or physical change applied by a product or a production supply, then you could also end up receiving an exemption for that side as well. So, and then our best case scenario is simply just, is it necessary and essential to the manufacturing process? So when you think about those, it's going to be, say, things like oils that are used to lubricate manufacturing equipment. If you're in a state that says this is simply just necessary and essential for the manufacturing process, very likely you're going to be able to take advantage of quite a significant number of exemptions. Exemptions, the consumables, the catalysts and whatnot, and also the raw materials. So a lot of opportunity on that part, just depends on the state. And then, of course, you also have states that are going to suggest that if it's not a machine and piece of machinery and equipment, then it's taxable. They're going to consider any type of consumables to be subject to sales tax. So another topic we have is on packaging supplies. And again, unfortunately, there's variability on this one as well, which makes it a little challenging. But the 2 things to really consider is whether or not the state is going to distinguish whether or not you need to have a non-returnable packaging supply or returnable packaging supply. So the non-returnables are going to be typical things that you consider that essentially the packaging of the products, right? If you have like a box of donuts, it's going to be like a donut box and all the ink and maybe like tape or whatever you use to seal the box. When you think about like returnables and things like that, you could talk about like beer kegs or returnable pallets, or maybe buckets used to move like poultry around and whatnot. So there's a good deal of variability. Some states basically offer exemption on both sides. Most states offer exemption on the non-returnable, and some states offer exemptions on the returnable side. And then finally, the utilities component. So this is like the 4th key area here. So manufacturers generally have a very high amount of spend in utilities area, and it's really key to understand the potential exemptions that exist out there. So the issue that basically comes into play again with utilities, of course, this is not straightforward, is the electricity usage. So when we think about the machinery equipment, they're being powered by utilities. Are all those utilities used by the machinery and equipment exempt from sales tax, or is it all the utilities of the whole plant that's exempt from sales tax? So do we have, we apply an exemption for lighting and things of that nature, or keeping people warm, just like HVAC stuff? Or is it just very limited to specific meters at a plant? So if you have a certain meter that runs to like a big piece of machinery, then you can clearly say that that component's going to be exempt. But you also just want to consider that if I only have 1 meter for my whole facility, then how do I determine what portion is an exempt utility, an exempt utility usage? So that kind of gets into the topic of, do we need to do a utility study and find out the percentage of utilities actually utilized in the manufacturing process? Or do we luck out and have a state like Georgia that's going to say, it doesn't matter where the utility is used. If you're a manufacturer and it's used in your site, then it's exempt from sales tax. Now, there is a word of caution on that, of course, too, because since utilities are generally such a high amount of spend, you'll have certain states that provide like a complementary tax. So meaning that utilities is exempt from sales tax. However, are there localities and whatnot that the state allowed localities to basically assess an additional tax on top of that sales tax. So for instance, Georgia has this local excise tax that there's no sales tax on the county and cities usage and whatnot, but there is that ability for those counties and cities to come back and go ahead and collect the excise tax. All right, so now that we've addressed the 4 key exemptions that can lead to immediate cash savings, there's also one that is really just like a subset of the production supplies that we were talking about a little earlier. And honestly, this isn't any like new exemption or whatnot, but businesses are definitely experiencing a significant increased spend due to COVID. And basically what we're getting at is due to the increases of spend that you're seeing on gloves and masks, eyewear, any type of protective apparel, and even further, some states are going to allow exemptions on safety equipment that's used within the manufacturing facility. But it's really key to kind of look into this a little further and just make sure that the states that you're located in and operating from do indeed, they do offer these type of exemptions. So if you look into and find out that you have a significant increase of spend, you're buying all these additional items, and your state does offer these items, definitely take into consideration that an exemption certificate could be provided to take advantage of this. So that leads us into sales tax training. Now, unfortunately, most companies take a more reactive than a proactive approach when it comes to sales tax training. So when we're talking about, say, the reactive approach, generally what that means to me is that, and I've heard the last 2 presenters basically say the exact same thing. This is how it's always been done. This is how we're going to keep doing it. However, in the sales tax world, this is how we're going to keep doing it, and then we're audited, and then we get dinged with an assessment, and then we get our training, and we go ahead and make our changes going forward, so we can avoid any type of potential assessments in the future. Now, there are several benefits. Basically, there are several benefits in taking advantage of sales tax training and being more proactive. So you can look at this from 2 perspectives. You have one, the sales side, you have one, the purchases side. If we do consider just the sales side of activities, we're really going to be focusing on where is my business obligated to collect sales tax or an exemption certificate? Am I charging the right type of sales tax rates? So due to Wayfair, there's a lot of different, almost all jurisdictions, honestly, other than Florida and Missouri, have enacted statutes that suggest that businesses can have a filing obligation within a jurisdiction simply through exceeding economic thresholds. Now, there are some considerations, right? Sometimes you consider whether or not it's Does the state consider retail sales? Does it consider gross sales? Does it consider transaction counts? So a whole lot of variability on this. But by training staff to understand where those obligations come from, it'll help lead to reductions in audit exposure. So for instance, if I'm located in Georgia and I've exceeded the sales thresholds in Iowa, now that I've exceeded the thresholds in Iowa, I would have an obligation to collect and report sales tax and also to collect exemption certificates. So if I'm doing what I'm supposed to do and I'm billing my customers in Iowa sales tax, sounds kind of odd, but it will lead to more satisfied customers simply from this one standpoint. Now, when you think of like an audit occurring, you have two parties, right? You have the company making the sale and you have the company making the purchase. Now, if I'm the company making the sale and I'm doing, I've registered, I understand I have Nexus, I'm beginning to collect sales tax as needed, so I'm doing things great. If an auditor was to come in to look at the purchaser and see if they paid sales tax or they reported use tax, the auditor is just going to bypass that particular your transaction, so they can see that tax is essentially being collected. Now, if you run into those instances in which the purchaser, there's no sales tax on the invoice, you don't have a extremely sophisticated customer here, and they're not accruing and reporting use tax, then it could result in the customer being audited, and then they'll have, not only do they owe the tax on their invoice, but they also owe like an extrapolation, a projection of additional tax on top of that, plus interest, plus penalties. So doing things, making sure that you're collecting sales tax as needed, of course, will help reduce the risk of having like unsatisfied customers in the event of an audit occurring. Now, we also have the purchase side, and this is kind of just really reiterating what we talked about with all the exemptions. If your tax decision makers, your sales tax people are trained, they understand what the production process is. They understand, say, I'm in a necessary and essentials or an integrated plant theory state or direct use state. They understand really what the parameters are of taking advantage of these exemptions. Then they can, they can hand out these exemption certificates to their vendors without necessarily having any type of risk of exposure. They can buy the goods exempt from sales tax, provide their certificates, and then and buy the goods tax-free. Now, the important part is, though, it's just, say I'm in a direct use state, I can't hand out the exemption certificates like willy-nilly. You have to know exactly where these items are being used in order to take advantage of the exemption. Because if we're just handing out exemption certificates left and right, then there's definitely going to be some risk there. It's very likely that when an audit does occur, there will be some form of assessment that comes out of this. So just getting the training going ahead and getting everybody so that they understand what the process is for the business and how the laws will not apply to your state, then that'll help make sure that'll help create those immediate cash savings and also reduce potential audit exposure. So this is really the last couple slides here, and this has to do with exemption certificate management and managing exposure. So this is a topic that I run into with almost all the manufacturers that I deal with, honestly. The issue that comes to be is, whoops, for some reason. The issue comes to be is either exemption certificates are not being collected at all, or there's only a portion of the exemption certificates being collected. And given that all sales of tangible personal property, so any type of like physical good that's being produced, is going to be generally subject to sales tax unless there's some kind of statutory exemption across the board. But generally speaking, all tangible property is going to be subject to sales tax unless an exemption certificate is collected. So in the event of an auditor comes in, they see you sell tangible goods, then they're going to want to see either tax collected or an exemption certificate collected. So given that this is like a major problem for most manufacturers, that they either don't collect certificates, they have no idea how many certificates are missing, it creates this real like crunch time where there's usually some significant form of outreach or some kind of campaign that businesses basically end up reaching out and seeing if we can fill in the gaps and determine who's where the most material customers are and whatnot to support these exempt sales. So really, how does this actually get fixed though? Where do you actually start on this? So there's a thought on this. One is I can take a look at all my sales activity. I can take a look at all of my exemption certificates. I can match them all up, and I can see where the gaps are. If I find out where the gaps are, then I can create a plan and do some form of outreach. If it's a couple of certificates that are missing, probably pretty simple. Just make a few calls, talk to the AP departments of your customers, and it's a very common request. Just request the certificates and basically help eliminate any type of exposure that would have come from missing certificates. Or the other option really has to do with a full refresh. So full refresh is, I don't want to go through the effort of basically looking at all these old certificates we have, or they're all in storage, they're difficult to get to, etc. And we just want to find out, hey, who are all our customers and what do we need to do in order to refresh all these certificates? Because there are some certificates that do have expiration dates, and honestly, there probably are a number of certificates on hand that they're missing signatures, they're incomplete, etc. And even if you do have the document and if it's not completed accordingly, then you could get pushback from the state. So it's kind of important to review these certificates, even if you do have them when they're received, to ensure that they're completed accordingly. Now, we're saying to ourselves, hey, we do know we're missing certificates, so how do we fix it? Again, it really depends on like how many certificates are missing, essentially. If it's just a handful, 5, 10, 15, 20, then I would just make the calls out, myself. I would self-manage the process. So you call, or when I say myself, I'm just putting myself in your shoes. You call, talk to your customers, give the certificates. But if you find yourself that you have 100 customers and 200 customers, plus a whole lot of customers, and it's going to be a major ordeal to go about collecting these. A couple approaches. One, you can utilize software to do this. If you utilize software, it'll assist with basically generating the campaigns and tracking information. However, there still will be a significant part on your side in which, okay, I got certificates. Now I need to actually review these certificates, make sure they're completed accordingly. I'm not getting a birth certificate on here or a picture of somebody's family. I need to actually see that it's a legitimate certificate. Or you, of course, can just outsource it, pretty much like with any type of sales tax related thing. You can outsource it, have another party basically, get a list together, and then do the whole outreach. All right, so the final slide I have here is on managing audit exposure. Now, this is a practice that Cherry Becker's really been doing for a few years, and it's kind of a health check, if you will, kind of to steal the terminology from the last presentation. So what goes on in the managing audit exposure, these compass reviews, if you will, is there's an annual review. You take a look and see if your nexus footprint has changed due to Wayfair, if you're making the right taxability decisions based on your sales, are they mapped accordingly? Is the sale of A taxable and the sale of B exempt? Are the rates being billed accordingly? Are you collecting exemption certificates? And really the same also applies to the purchasing side, right? Are you paying sales tax accordingly, or accruing use tax accordingly, or anything along those lines? So if you haven't had an actual audit from a state, and you feel that there are some risk areas within the business, then it's usually a good idea to either consider doing an internal audit and testing those areas, nexus, taxability rates, am I paying sales tax, exempt certificates, etc., or again, outsourcing it to somebody else to basically take a look at your records and whatnot. So, and who knows, you may find instances in which, oh, well, I'm actually overpaying sales tax. And if you're overpaying sales tax, then even better news, right, than all the potential underpayment risk that exists. And with that, that concludes my presentation. So I'll transition over to Danny for a few words.
Thank you so much, Chris. Really do appreciate it. It was very informative, as were all of our presenters today, from Bryce starting out on the leverage analytics side to the cash flow optimization from Aaron and Dan, and then the tax savings that you spoke about. I hope everyone on the line was able to get as many good takeaways as I did. If you'd like to hear more from or ask questions of any of the speakers, feel free to reach out to Eric or I, and we'll make sure to connect you with them. Just as a few closing items, I want to thank the whole marketing team, the entire team over at Cherry Beckert for all their help and hard work getting this webinar set up, and everybody on the phone. We appreciate and know that everyone's busy. Appreciate everyone's willingness to take their time today. Everybody have a great rest of the day and good rest of the work week. Thanks.